welcome to the PPW Podcast, bringing you news, views, and interviews from the world of real estate, online marketplaces, and prop tech industries. My name's Harvey Hancock. I'll be your host today. I'm news editor at Online Marketplaces. As always, we are with Simon Baker. Simon, how are you doing?
I'm doing fantastic, Harvey. Great to see you again.
Great to see you too. Couple of weeks ago, we did an episode about Property Guru Group and the fact that it was maybe going to be taken private after just 2 years on the public stock exchange.
Yep.
It raised an interesting question, which we didn't really get to spend too much time on because we were talking about Property Guru, about what it's like to be part of a publicly listed company, how to run them, how to list them in the first place, how to delist them, whatever it may be. And Simon and I decided that it would be worth a conversation in and of itself. So today we are going to be talking about the double-edged sword that is being part of a publicly listed company. So, Simon, how many publicly listed companies have you been a part of in your time?
I was just trying to write the list down here. I've got to
I've
eight.
got four. I've got four, as in terms of being maybe in charge of.
Yeah, so I've been involved in about 7 or 8 in that process, and they've been in various roles. I've been a CEO of the REA Group, of course, which is a listed company, I should say, in the Australian market. I've been chairman of a range of companies, including the iProperty Group, Mature Group, PropTech Group, Real Estate Investor, and so on. And I've been on the board of other listed companies. The list goes on, but not chairman. And then I've also listed companies, which means we've taken them from a non-listed state and applied to put them onto a stock market, gone through that process of writing a prospectus and raising money and so on, and becoming listed. And the companies that we did that for were the Mature Group, PropTech Group, Real Estate Investor, and I also did a SPAC on the NASDAQ called Genesis Growth. Okay, so I've been involved in 4 that I remember in the listing phase. So a lot of experience in that process, a lot of ups and quite a few downs.
I can imagine. Process. I'm going to sort of have to let you lead the conversation on this one because you're the one with the experience. So I guess my first question is, what are the big overall themes that I need to be aware of when it comes to being a publicly listed real estate portal, real estate company, prop tech, whatever it may be?
A company, really, at the end of the day. So the question is, let's break it down. Why do people list? Okay, and there are many. There are a few different reasons for that. And then, having talked about why people list, then we'll talk about what life is like being listed. Okay, and then we'll talk about delisting.
Okay? Sounds like a great life cycle.
It's a life cycle
on board.
That many go through in this whole process. So, why list? First of all, many people who most of them haven't been through this process see it as the holy grail. Oh my God, I'm going to become super rich. I'm going to have freedom. My shares are going to be on the stock market. I'm going to be a unicorn. Watch out, Elon, here I come. Okay. And so they see that as a mechanism, right? And it's a mechanism to create liquidity. So you think about, you have a private company, you're building, got good growth, and you want to create liquidity, meaning I want to sell shares, some or all of the shares, so that I can convert the ownership in a company into cash in my pocket to do whatever I want, invest, buy a house, and so on. Now, people also list to raise money. Okay, I want to raise money, and away we go. So when we think about share markets, what happens is you say, I want to list on a share market. First of all, your company's got to meet some criteria. Okay, some are about the company itself, operations, how big you are, your cash flow, are you profitable, are you not profitable, and so on. And the second is your shareholder base. You've got to have at least a minimum number of shareholders to list. You can't just have one shareholder. You've got to have, depending on the stock market, 300, 500, and so on, to list. And so what happens is you go through a process. First of all, you go and engage accountants and lawyers and so on about them helping you go through the listing process. You end up with a stockbroker, an accountant, lawyers. The lawyers do all the legal work, compliance work about listing. You make an application to the stock exchange to list. You say, this is the company, this is how we perform, we would like to list. Can you please say it's okay? Because if they say it's not okay, then they go, then you don't do any more work. You then have to do a whole bunch of work around the analysis of financials, because in your prospectus, which is usually 130 odd page document, 132 page, I think we've written more than once, you have to outline everything about the company, its history, where it started, who its customers are. You have to show historic financials going back 3 to 5 years. Okay. And that's all got to be audited. So that's where the accountants come in, the PwCs of the world. Then you're probably doing some projections, although you always try to avoid projections, but you probably have to do some about what's going to happen in the business so that the stock market know, or shareholders know, what they're buying into. And you assemble all of this and you write lots of legal documents, more pages of legal stuff than you've ever wanted to see. You have lots and lots of meetings, and it can take anywhere from, I think the fastest we did one, which was a real estate investor, was about 6 months. And then the longest would have been Genesis, which took about a year. Right? Because once again, each share market has different requirements. So something like the NASDAQ or the New York Stock Exchange has far higher requirements than something like the Australian Stock Exchange will have. And then, of course, you've got to make sure your internal systems and processes are fantastic. So one of the things we had to do was, you have to put in, if you're going on the US markets, you have to be SOX compliant, SOX compliant, which is a high level of compliance you have to do about internal systems and processes and what you've got, what you're doing to ensure that all the numbers and the performance of the business is legal, above board, accurate, and so on. Because you as the board are putting not only your name, but your personal wealth behind saying that this is a fantastic business and you should invest in it. And then having done all of that, you then work with a stockbroker to raise money. Because when you list, you take the company as it's performing, and then you're probably raising money, saying, give us your money, raising 10 million, 20, 50 million, whatever it is, hundreds of millions. With Genesis, we raised 250 million US dollars, I think it was. So then you just go and do what's called a roadshow. And you talk to funds and more funds and more funds about what you're doing, why it makes sense, what's the growth prospect, and you should take an allocation on this. And you go through that process and you try to raise whatever money it is you need in that process. At this point, you've not created liquidity for yourself. Because as a founder, what they're going to say is fantastic. We love the idea that you're floating your company. One requirement, your shares are escrowed, locked up for 6 months, 12 months, could be 24 months. Okay? And you can't touch them. Why? Because they don't want you to list your company and then you sell your shares and disappear off into the sunset. Okay? Because the share price goes down the toilet and away we go. So that's why people list and how you list the business.
And then the fun starts.
The fun, oh my God, the fun does start.
Go on then, Simon.
So being a listed company, if you're doing really well and you've done a great job at marketing the company and you've created a lot of demand for the shares, because you want to have people who want to buy the shares once you're actually on the market, then then things go well. Share price goes up. Okay. And of course, you then have good share, announcements to shareholders, our revenue's growing, et cetera, et cetera, et cetera. Okay. And, we said we're going to do 50 million, we're doing 55 million. And everyone goes, fantastic, you're above. Okay. Now, funny thing is, you can outperform your projection, but not too much. If you outperform too much, people then question your forecasting. Okay. Well, you were not very good at forecasting. So how do we believe the next numbers that you release? If you forecast and then you miss, even if you miss by a very small margin, you often get smashed by the share market. They say, no, we lose faith. And because the share market also moves like sheep, okay, or lemmings some days, they all jump off the cliff together. And what I mean is they start selling. One fund sells, they see another fund sees them selling, so they sell. They don't know why. They just don't want to be the guy who's left holding all the shares at the end. So your share price can tumble down for the most innocuous reasons.
Even though you're performing with 0.5% of what you had forecasted.
Yeah, well, you might miss by 2 or 3% or something that is within a reasonable margin of error. Okay.
How many times did you go through that as someone in charge of
2 or 3 times?
Tell me
And
about it.
the problem is once you've and actually no, another company I was Redbubble. I forgot about that one. Right. And that's a good example, right? Where if you constantly miss the forecasts or projections, and by the way, you may not be missing the forecast, you may be missing the industry consensus. So what happens is analysts will be looking at your shares and they'll form their opinion and they put out a report. If you're lucky enough to be followed, of course. Most companies don't have any analysts following them. And those reports, there becomes a consensus. So 5 reports, they take an average. This is what the industry consensus is. So even if you have not told the market anything, the market already has a view on what you're going to do. So if you miss a number that you didn't even set, you have a problem. Okay? So a lot of your job is how do you manage that expectation while not giving them insider knowledge, because you can't share insider knowledge without sharing to the market as a whole. And so on and so on and so on and so on. There's so many little things you have to deal with.
Tell me about, let's dig into the managing expectations aspect, because I know we're going to be having listeners to this particular episode who are maybe running a privately run company or whatever it may be. Tell me a bit about managing expectations and how you get it right without being able to predict the future.
The best way to do it is you create the underlying model for the business, but without numbers. So this is how we think about the business. It's X times Y times Z minus A and B and C, right? That's our model. That's how it all works together. Traffic giving leads are being sold or whatever you're doing, okay? So if you're going to model my business, at least start with the right algorithm, okay? Now, luckily, 3 of these numbers are public knowledge based on whatever, right? Volume of house sales in the market, it doesn't matter. Stuff that's macroeconomic, okay? And then these other ones, well, I can give you some guidance and I'll give the whole market guidance. It could be average number of sales per salesperson. I don't know, just whatever it is, right? And then some of them, we say, look at the history. The history is a good indicator for the future. Okay, and expenses, you're just being very clear on what you're doing with your expenses. So you give them a model that allows them to forecast. That's how you help manage expectations. And of course, if any analyst, and second is you've got to be proactive, talk to the analysts. Okay, do you have any questions, sir? Right? Are you updating your report? Are you updating your projections? How are you thinking about it? I wouldn't be thinking about it that way if I was you. Right? Because part of their credibility is not being too inaccurate. So there's this whole ecosystem that revolves around that. So managing expectations is very important. You do market, when you do your quarterly or half yearly market updates, you want to give people guidance without necessarily giving them guidance and so on. It's much an art as a science. And you need to have a very good process for doing it. Okay. We always had an industry relations sort of manager. I used a guy called Dave Platter. He's very, very good.
I
Good
know
at
the name.
managing the
He sent
expectations
me a
and good
couple
at
of emails
communicating.
in my time. Yeah.
So that's sort of how you manage expectations in this. Now, if you do it well, your share price should accurately reflect or closely reflect the true value of the business. Okay. Now, one of the problems is when you're a listed company and there's macroeconomic impact, right? E.g., inflation goes through the roof. With inflation going through the roof, the prices of stocks and bonds go up, which means that a lot of the money that was in the market comes out of the market because it was investing in the share market when interest rates were low because they're looking for a higher return. They can now get a much higher return out of stocks and bonds without being in the share market. So money comes out of the market. If money comes out of the market, they're going to sell your shares. Or a fund. I've had this happen more than once. A fund has a redemption. So it means that one of the shareholders of the fund wants their money back. The fund has to get the money. How does it get the money? It sells the shares. And they don't care what price they get. They've got to get the cash. So they sell your shares. So then you've got to say, wait, before you sell the shares on the market, let me know. Because if I know a buyer who's going to do what's called a block trade, they want to buy a lot of shares, we can cross them. Okay, so it's called an off-market transfer. And that will mean that it's not going through the market, which means that we don't end up with downward pressure on the share price. A lot of things to take into account in managing a listed company.
It's nightmarish. I mean,
No, it's not nightmare. It can be fun because the answer is you have a team, right? Because if you're listed, the other thing, it ain't cheap. Yeah?
tell me more.
Even on some share markets, you're spending millions of dollars a year in fees, lawyers, auditing, a board, and so on. Right? And if you're spending that much money, right, you better be earning a lot more money. It better be worth it in the long run.
Well, that brings up an interesting conversation because we've spoken about two businesses that come straight to mind here. One is obviously Property Guru, which is maybe set to be taken private. And also we spoke to Greg Bader at rent.com.au, which is a microcap business. And he said very transparently on the podcast to us that maybe it's a business that shouldn't have been taken public.
Yeah, agree.
So what is the profile of a company that should be taken public, and what is a profile of a company that should remain private?
Size, scale is the first thing, right? If you're now depending, and that's a market dependent question. So quite often, the Australian stock market was almost like a VC market. It was a way in which you could raise money because the VC community wasn't that big. In the US, if you're small, then it's much harder. You just wouldn't even bother because there are thousands of shares. No one's ever going to look at you. And I've been involved in shareholders in companies that are you call it trading by appointment, which means no one's buying and selling your shares. So the daily trades are in a couple of thousand shares, which is nothing. $700, $800, or whatever the market cap is. So you need to have scale, strong revenues, profitable, great growth metrics, be something that people can understand very quickly, always helps. Because a lot of your retail investors, they are the mums and dads, right? They don't understand. But you go, well, that property portal that you use to buy the house for your kid, you can buy shares in that now. Oh, I got that, right? But if you're some complex scientific process, much harder to communicate what it is you do. And a lot of that's very important for helping drive the share price because what keeps the shares going are the mums and dads trading every day, creating enough movement in the market, enough availability of shares for people to buy a position, sell a position whenever they want to. So scale, scale, scale. Okay, I can say it for another half hour. It's still scale.
It's all about scale. I mean, we've sort of got a bit we took a slight detour there. You've gone public, and now it's time to delist.
Well, what is delisting? So delisting happens one of two ways: a good way and a bad way. So, like all things, you can actually be forced to delist your company from the share market. And delisting means that you're no longer trading on the stock market, and that can happen either because you failed to meet the criteria for the share market, i.e., minimum turnover rates, a minimum market capitalization, and so on. Right? If you don't hit those, then eventually that you are forced to um, delist from the stock market. In Japan, we were looking at a company there once, and if their I think its enterprise value fell below a certain number, they had to delist. Okay, or their market. I can't remember the exact equation, but you could be compelled to delist, and that's never. Or clearly you go bankrupt, right? Then you delist.
I mean,
All of those
we've
are
got a couple of examples that I think was it one of the Russian portals got forced to delist from Nasdaq after the Ukraine invasion. I think there
yeah.
was
That's a totally different issue again. That's the in that case the
like a
various stock
political sanction.
exchanges changing their rules. They said, sorry, we will no longer allow Russian or Russian associated companies, Cian, Headhunter, and so on, to be listed on the stock exchange. That's another reason. That's a relatively unique reason. I think there were about 10 or 15 companies that were caught up in that whole reason for delisting across multiple categories.
We also had, I think, was it Fang or Fang DD in China was forced to delist because it wasn't sharing its interim reports to the market. I think it went something like 6 to 8 quarters in a row where it just didn't say anything.
Well, that you can't do that either, right? That's another reason. You failed to meet the rules of the exchange. And in this case, you must provide a quarterly update within 28 days at the end of the quarter to your shareholders of the performance of the business. Blah, 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 right? If you don't do that, you get notices and then you get suspended. You can be suspended, right? You can be temporarily suspended and then you can be permanently suspended. Okay, and then there's a whole bunch of rules about them becoming unsuspended. So for example, when speculation was in the market about REA and Rightmove about 2-3 weeks ago now, REA self-suspended. It suspended itself from trading. So suspended from trading, right? While they prepared the announcement. Then they made the announcement and then they allowed trading to start again. So that there wasn't that period of time where there was an asynchronous amount of knowledge in the market. Some people knew more than others. That's the real thing, right? You've got to allow the synchronicity of information. Now, so that's the negative reasons why people end up delisting, which is a painful process. By the way, what happens is you as a shareholder still have shares in the company, but the company is not traded on the stock market, which means how you sell your shares is much harder. And then you can have there's various other mechanisms, there's over the counter and so on, as other ways of trading shares, which is like a sub stock market. If you understand. So you can trade. If I know you've got shares and I've got shares, we can come to an agreement and we can quickly sell them over the counter, buy and sell them. And then, of course, if you're a totally private company, then you've got your shareholders agreement that controls everything. The positive way is when someone makes an offer for your business. REA offering to buy Rightmove. Okay, Lifel Connect or Lifel in Japan offering to buy the Machula Group. MRI in the US offering to buy the PropTech Group. The last two I've been involved in that delisting process. And what happened then is they came to the board. MRI came to the PropTech Group board and said, we would like to buy your business. Okay. We then negotiated with them. Joe Hanna in particular did a lot of the negotiation. I think they originally offered X, I don't know, 70 or 80 cents or whatever it was. And we said, no, we're not going to support that. We're not taking it to our shareholders. And by the way, as the board, we can control 30 or 40% of the shares, so you can't buy it anyway. You can't go to the market and buy it because we've got a blocking stake. But if you make a better offer and we like the offer, then we will support it. And by supporting it means we will we guarantee to sell our shares to you if the shareholders buy it, accept it. And we got them up to 90. Oh, I don't remember. I've totally 96. It went from like a 70 million offer to a $96 million offer. Okay. I don't know what that works out in price per share. It's too long ago now. And the same with the Mature Group. We negotiated as a board with Leifel in Japan and got to a deal that worked for both sides. And that was a cash plus shares type deal. So they're the sort of things that you do. And that's a friendly takeover. And what happens is...
Sorry to cut in there. Did you prefer the cash only or the cash plus shares as a board?
Cash.
Just want the cash. You just want to say goodbye.
Cash. No.
Cash.
No. Doesn't mean you want to say goodbye. But if the cash is in my pocket and I like what MRI or Leifel are doing, then I can buy the shares. Nothing's stopping me. Okay? Because otherwise I am now in a world where I've got to go, wait a second, I've now got Leifel shares. Oh, wait, that's on the Japanese stock market. What am I going to do? Tokyo Stock Exchange. How do I sell these? Got to go set up a special bank account. I'm going to do this. It's a headache. So give me the cash, then I can determine what I do with it myself as the outgoing shareholder. And then you just go through a process to delist. It ends up being a process where the board supports it. You fill out a document, another 130 odd pages, to be honest, of why you support it, why this is the best option for the business. You have to tell the shareholders all the performance of the business and blah, 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 blah. It's long. It's a long document. I was looking at it the other day from PropTech Group going, my God, we wrote all of that. Okay. Lawyers, and it costs a lot of money to delist in this process. Of course, you factor that into the price. Okay. And then you go through it. The shareholders vote. In the case of PropTech Group, it was the vast majority voted yes. Some people didn't vote. Well, your vote it's just not counted. Of those who voted, how many voted yes? That was enough to accept the deal. Deal occurs. All those who didn't bother voting got the outcome anyway. Okay. And then that whole process can take 3, 4, 5 months to go through, because once again, it's all about ensuring at its core of listing a company and delisting a company. At its core is making sure that the directors have done their job, which is a duty of care to all shareholders, to find the best price, to tell them exactly how the business is performing, to tell them about the projections to the best of their ability, to make sure that everything is above board, that everything is legal, and so on. That's what it's at its core, what this whole working in stock markets is all about.
I mean, how do you ensure that the business is still operating without being distracted by what's going on in the background?
You pay a lot of money to advisors.
Okay. Yeah.
You have advisors that they advise you on the sales, so they help you negotiate, they help you do the contracts. You pay a lawyer a lot of money. You probably pay your auditors. You've already got auditors. So you pay them extra money to help do all the final accounts, etc. So everyone knows exactly what is being sold. And you hopefully have a big enough team that you can dedicate 1 or 2 people to the sale process without distracting from the day-to-day operations. Now, clearly, then there's a whole bunch of other issues because it's all public. Right? It's all public. So employees go, well, what's happening? What's happening to my job? So in parallel, you're talking to the acquirer. So MRI in this case. And we had the guy's name's David Bowie. There we go. That was the guy who ran Southeast Asia for them. He was in the offices for PropTech Group, so everyone knew who he was. Great guy. He's a really good guy, and he said, "This is what we're going to do. This is don't worry. This is what our plans are." They already had another product set, so they merged them together, and so on.
We're coming to the end now, and I just want to do a bit of a zoom out, I guess. I guess one little anecdote from you first before I ask my big question, which is what was your biggest win or your biggest loss, shall we say, on the public market in terms of just maybe not necessarily financial, but something that you could necessarily take pride in, or maybe something that you wish you hadn't done and would warn against in the future?
Biggest win, creating the REA Group.
Makes
$8 million
sense.
to $27 billion. I think it's going to be hard to beat that one.
That sounds like a win to me.
That's a big win. I think the other big win, Machula Group, because I was literally invested and worked with the founders there from the super early days, and that's a big win. Taking a company based in Madrid, Spain, all the way through to the Australian stock market to then sell to a Japanese company. Man, that's a cool story. And by the way, and along the line, creating 180 million euros, or I don't know exactly, some very in terms of value for shareholders from zero clearly upwards. PropTech Group, another really good story about taking an asset from Domain, taking another private CRM system, buying a few along the way, putting it all together, spending about $20 million doing all of that, with a listed market, and then selling it for 96 million in 2.5 years. Super good stories. Real estate investor, bad story, where we listed a company that was too small to list, but I can't remember why we listed it now. Too long ago. It was a decade ago. But we had some justifiable reason why we're listing, probably to raise money. It was the easiest way to raise money. And a stockbroker who was willing to help us raise money and did help us raise money. So that was good, but then we couldn't execute it well. The CEO we had changes of CEOs. You got hit by a housing crisis, not a housing crisis, just the investment market crisis in Australia. And the thing basically went to zero, almost zero. But the good news was in that process, we had a shell. And that shell became the PropTech Group. So we then, used the shell to do some stuff, relisted it because the REI became a delisted company because of lack of liquidity, all the reasons we talked about, the negative reasons for delisting. That's how it went over time. So yeah, they're probably the ones that I'd put in the category of the good. Lots of good, bad, and I'm not going to talk about SPACs because honestly, that's a whole different topic of conversation.
We'll skip the SPACs.
Yeah.
A public company you admire, and it can't be one of your own.
Oh no. A public company I admire in this space or any space.
Dealer's choice.
Okay, I think in this space, I'd say, I've got and I can't say the REA Group because I think that clearly they've done a great job at creating shareholder value. I admire Rightmove and what they've done because I think they've done a great job at creating enormous shareholder value in that market. I like how they've just really stuck to what they're good at and just done that repetitively incredibly well.
One of the most consistent businesses in real estate worldwide.
Yeah. Oh, I like what they've done there. I like the Baltic Classifieds Group because they've got a better EBITDA margin than Rightmove. I think that's a good story. So they're the ones I think have done really well in the markets. Yeah.
And last one from me is let's fast forward, whether it's 5, 10, 15 years. Are you foreseeing more or fewer publicly listed portals?
Fewer.
Tell me.
Fewer because I think a lot of them will be bought up by the big players before they go to listing, or they'll be bought out by private equity firms. Um, and I think a lot of the ones that are in the market today owned by private equity firms will just be sold to another private equity firm. We'll just do that little, as Andy Florence said, all they do is keep selling to each other, okay, in that loop to generate sort of returns around it. So I think that's, I think probably fewer over time. And I think we've probably got fewer than we had probably about 3 or 4 years ago. We've probably got fewer than we had since then in that process.
Is that going to be to the detriment of the industry by having more closed doors and fewer? No.
I don't think in terms of it for investors, yeah, but for everyone else, no, it's not going to make any difference. Just different owners. I think if anything, those when you have a private equity owned, results driven, very aggressive results driven business, I think that they will get good performance. So, no, I don't think so.
And what about on the consumer side for regular mum and dad house buyers and sellers? Is there ever going to be any significant difference in the ownership structures for the businesses that they're buying and selling houses from?
Does it matter to them? No. They don't care. Is there a listing? Yay! Do I like it? Yes. Can I buy it? It's available. Fantastic. Deal done.
That was a bit of a stupid question, really, wasn't it? Shouldn't have bothered asking that one.
I am not going to answer that question.
Fair enough. I know what no comment means. Right then, Simon, we've been at it for 37 minutes now, so I think it's a good time to wrap it up. Thank you for your overview of what it's like to go public and then delist. A couple of nice anecdotes along the way. And go on, we'll do a Barcelona.
Yep, for a big last pitch for those who don't know, probably by the time this goes out, on the 2nd to the 4th of October, we're running the Property Portal Watch conference in Barcelona. You should be there. We've got 300 plus C-level leaders from both listed and unlisted companies talking about how AI is impacting the prop tech and property portal industry. And it's absolutely must attend event. The day before, we run a startup day for those who are dreaming and aspiring of becoming listed one day. We are running a full session around what it takes to become a listed company. Not a listed company, a startup company that's successful. And we do touch on listing. Should you, shouldn't you? But we talk about capital raising. We talk about how to grow your sales, marketing, teams, think about technology, product, and so on. So it's a must-attend day for anyone who's trying to rapidly grow their business.
What's the website, Simon?
www.ppweurope24.com. That's ppweurope24.com.
Thanks very much for watching, everybody. Until next time, it is goodbye from Simon Baker.
And it's goodbye from him.
Goodbye.
Bye-bye.